maybe we'll start on that note because we've got Martin Crabb from Shaw and Partners with us. Martin, we'll get to the news of the day, but we may as well throw your hat in the ring. Qantas, have you ever been interested in it? Have you ever been a holder of it?
Yeah, we've got it in our core portfolio. It's our recovery trade stock. So we're still seeing, we had helped the management from Hello World in yesterday. The travel agent used to be Thomas Cook.
Yeah.
And they're absolutely flying, right? So we were saying off air how people over the age of 55 who don't have a mortgage are loving these higher rates. They don't have the energy bills, they don't have the mortgage bills, they don't have the school fees, they're all done. And now they've got all this disposable income that they built up during COVID that they're having a fine old time spending. And of course, travel's the go-to for people. And as you said, Danny, Paris looks better than Palm Beach, I suppose, for a lot of people. So look, we like Qantas. So if you want to play reopening even more broadly than us coming out of lockdown, but more globally, China coming out of lockdown, etc., it's pretty hard to go past airlines. And without the competitive dynamics that you have in the US market, where you've got 60 airlines all fighting for share, here you've got pretty much 1.5. So yes, yields have come down, but they're flying a lot more planes. They were flying 1 an hour or maybe 2 an hour, Melbourne, Sydney. They're back to 4 an hour now. So they're basically working the fleet a lot harder now. So they're probably, I mean, Alan Joyce has timed this absolutely perfectly, hasn't he? He's done an Alan Moss. You know, he's got in at the bottom and got out at the top. And he'll be remembered for creating a lot of value, probably a lot of angst amongst customers too. But you know, if you look at when he joined Qantas and the problems they were having, and you look at it today, the rude health that it's in today, and you're right on CapEx, they've got to spend $24 billion on new planes, but they can actually do that now. They've actually got the balance sheet to be able to do that and do buybacks. Whereas when he took it over, the thing was on its knees. So you know, kudos to Alan Joyce.
Yeah, but let's move on to this RBA rate hike. Okay, so you know, the wait and see how the lags took effect suddenly became, well, no, we're going to move. What light do you think has been switched on in the RBA boardroom to create this hike?
A little bit of an insurance policy against, the housing market started to pick up. The labour market's not really loosening up, despite the fact there's a lot of immigration going on. The unemployment's still at a 50-year low. Business confidence is okay. Consumer spending's okay. They're not really seeing the deflationary pressures in the economy that they want to see. And they really had to go on pause last time because of Silicon Valley Bank, right? I think all the central banks probably got on a phone call and said, look, let's just pause. So the Fed paused, they paused, the Bank of Canada paused. We'll see the Fed go tonight. We'll see the Bank of England go again. We'll see the ECB go again because inflation is still too high. They said that in their statement, it's still too high. So you look at measured inflation, yes, it's coming down, but it's still got a 7 handle on it, right? When you really look through it. And that's, you know, they're targeting 2 to 3, they're at 7, they've got to keep hiking rates. They've also got the Fair Work Commission coming out with a minimum wage decision, which also impacts people on awards. So it's only 1.5% of workers are on minimum wage, but about 25% are on awards. So it's significant. And that's not going to be a low number. The government sort of indicated they want to see real wage growth. So if you've got inflation at 7, real wage growth needs to be above 7. Now, I don't think the Fair Work Commission is going to come with 7, but then come with a large number. So you've still got this wage pressure that's sitting in the economy. So I'm not that surprised the Reserve Bank went again today. Now, there's people saying they're going to go to 4.35 or maybe even 4.6, and it's like, I think people are getting a little bit carried away with that. But I think 3.85 did make some sense, whether it was this meeting or the next one. And you know, kudos to those economists that called that. I think there was probably 9 out of 30 in Bloomberg that called it, and almost no market participants. So it did obviously come as a shock. We've got 1% off the market today, but you know, central banks are going back again. It's not, as I said, it's not just the RBA. We'll see the Fed, ECB, everyone except the Bank of Japan will put up rates. Maybe even they will as well.
I guess scrap yield curve control, who knows? But last month I asked whether it was, you know, like the equivalent of your mother giving you a sort of a dirty look and, you know, don't misbehave or I'll whack you over the head a little harder. Is this, I don't know, maybe even like a Dirty Harry kind of hike? You know, do you feel lucky? Well, do you? And, you know, the warning to the households that, you know, don't get too complacent here. Stop carrying on because we're going to keep pushing these things higher if you keep spending.
Yeah, look, that wasn't in the language, and I don't think that'll be in his rhetoric at all. He's not sort of blaming anyone for spending money. It's more about we have a duty, a responsibility to Australians to get this inflation under control because of the corrosive nature of it if you let it out of the bottle. And it's kind of trying to stick to that. They were really hawkish in February when they hiked then, and they surprised everyone how hawkish they were. They then went back the other way and became dovish and paused, and now they're sort of trying to get back hawkish again. I mean, they are in a little bit of disarray. I mean, their forecasting's been diabolical. They've had this review which has poked a few holes in the way they do things and suggested quite a few changes to how they make decisions and the process that they use and the communication around that. So, the RBA is not covering itself in glory. And again, once again, they've ignored the market. The market said, look, just stay on hold because there's enough deflationary pressure there. You don't have to do any more. And they've gone, no, we know better. So, tough job. I wouldn't want it.
No, terrible job.
But we'll just see what Governor Lowe says. But the surprise for me was not just the hike. The hike didn't surprise me. It's they left the door open for more.
Yeah.
So it's like we're not done yet. Which so the futures curve hardly traded today because it was pretty quick. But we'll probably see futures start pushing up again.
And do you think this is going to be the catalyst to get that old sell in May, go away thing happening for the markets with this more hawkish rhetoric coming out of Australia? We may see it out of the Fed, forget Japan as you said, but maybe this is now going to be higher for longer and we really are going to effectively crush the economies.
Yeah, I mean, the sell in May and go away is harks back to a day when people used to go on summer holidays and not trade, right? So that was the reason you sold in May and go away because there was no buyers around. But we're past that now. Maybe a lot of Americans still go on holiday in summer, but I think using the calendar to drive your investment policy is not something I advocate. But there are seasonal factors and we can't ignore them, and the sell in May and go away one is definitely one there. But I think in terms of central banks, I still think they are concerned that there's sticky inflation. They haven't done enough to slow down the economy to get rid of the sticky inflation. And yes, headline numbers are coming down and goods inflation is definitely coming down and global growth is clearly slowing. We're seeing that with all the PMI data, but they're just not seeing it in the underlying inflation data. Until they do, they'll probably just stay hawkish. The risk is that they over tighten. That's the biggest concern. And there's this whole argument to say, look at what happens during pandemics. When you have a pandemic or a war or something like that, the conditions are totally different than if you've got grinding higher inflation like we had in the 70s. It took 10 years in the 1970s to get inflation up to being a problem level. Here it's happened overnight because of the stimulus. So I think central banks need to use a different playbook to fight inflation this time. It will come down by itself. They just have to be patient. And so having central banks pause, hike, pause, cut, pause, hike is probably better than them just deciding that they need to get rates to a certain level as quickly as they can. So I think we've moved into that secondary paradigm where they're being data driven, and I think that's the right thing to do. But clearly they're saying we haven't done our job yet. We haven't got inflation to where we need it to be.
So just the investment implications there, because obviously we've seen equities off. That's going to happen when risk-free rates rise like this today. But I mean, how are you sort of looking to allocate your portfolio potentially? Because you said consumer discretionary could be at risk of an over-tightening situation. Clearly they're just going to be interest rate risks to the market. Even real estate actually came off quite considerably. Everyone's worried about commercial property. What are your thoughts there when it comes to portfolio allocation? Yeah,
so we're sitting in a stagflationary portfolio. So the view is, okay, if growth's going to be slow and inflation is still a risk, let's sit in stocks with large pricing power, quality growth stocks. So your CSLs, Amcors, Brambles, Transurban, these sorts of companies that can pass on higher costs. And our view was always, that was great last year, that did really well, but going forward, we might start to see a cyclical recovery. If rates are done and inflation's coming down, we need to get a bit more cyclical here. We need to start looking at residential real estate. We need to start looking at consumer stocks. We're now hitting pause on that. This rate decision here, and probably what we'll get from Governor Lowe tonight and also from the Fed this week, is that we're not done yet, and there's probably another leg down in earnings, or there's another leg down in sentiment about earnings. We don't need to see the earnings move. We just have to. And you mentioned the confession conference that happens every May. We're in day one of that. We've got 2 more days of that, and there's another, 30 or 40 companies to present there, maybe even more than that. Then we've got NAB on Thursday, ANZ Macquarie on Friday, CBA and Westpac Monday, Tuesday next week. So we've got a lot of data on the economy and the animal spirits that go with that. So from a portfolio perspective, stay in that defensive growth end of the market. Wait a little bit longer for that cyclical. Like we added James Hardie at Christmas. We just had to add something into the housing market, but we don't own any retail. We think retail's still going to be tough.